right, we wrapped up April with a mixed close. Under the surface, it was anything but quiet. The S&P and the Dow continued their winning streaks. The S&P at 7 days. The NASDAQ staged, and the S&P as well. Most of these major indexes staged an impressive intraday rally, recovering sharply from an early gap to the downside to finish near the highs of the days. And that kind of reversal says a lot about investor resilience, even as we have a lot of macro pressures mounting from the GDP numbers that contracted this morning, marking the first decline in a couple of years, driven by a surge in imports, the trade policy uncertainty, stagflation fears, which came out of the price index of the GDP, are now taking center stage. Meanwhile, rotation is narrowing, breadth is starting to soften up a little bit, raising the stakes for this rally. So in today's video, we'll break down of the technicals, like we always do. We'll take a look at the intermarket context, what's driving this action, sector leadership trends, of course, and also take a look at our trade idea and take advantage of a name in that technology space that is kind of doing what we want the market to do. So let's go ahead and get started. All right, today is Wednesday, April the 30th, 2025. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching here on our blog, make sure you sign up for our email list. You can do over here on the right-hand side. You can click this notification so it just notifies you on your browser when these posts are posted, the blogs are posted here. Here's our video that you're watching. If you come down to the bottom, you can click this heart. It opens up this tab right here. Hit that like button. That pops up. Also, you can see here, click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms, improves the reach of those posts. So thank you to those who do this day in and day out, and those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator here. Again, 7 days in a row now to the upside and almost average range. This slight kind of late push we had at the end of the day pushed us right up to an almost average range. Again, it's much bigger. So yesterday's range was 66 points, 85 points the day before that, 72 points the day before that, 117, 113. So they get to 148, even if most of that range was, it was early in the morning, but still, most of that rally here, we rallied from low to high throughout the day. So that was a 148 point move off the low to the high of the day, which is right there close to the close. So really good intraday move, where a lot of that move occurred over instead of overnight when a lot of the selling occurred, or actually early this morning when a lot of selling occurred after the GDP print and then the inflation print. The rally occurred during the day, and there's even more of a rally here in the overnight session. With Meta's earnings and Microsoft's earnings both looking pretty good so far. So, as a result, the near-term line stayed, not just in the reversal zone, but stayed up at extremely bullish levels above the 90th percentile. The momentum line jumped up to the 90th. So, we almost have a cluster here. You're just missing the intermediate line there at the 70th percentile, 73. Well into bullish territory. Again, not above 80 yet, but still in bullish territory and looking pretty good. Well above the market sentiment, which is rising. So, we're not above 2.5% above the moving average, and that's an issue still. We got this kind of quasi bull tag, and we've kind of built on it, but not really. Again, we're looking good so far in the after hours. If you look at SPY for an example, because we can see that in the after hours, we're up to 560 right now from 554. So 560 would be right here where my cursor is. So that would complete. We have pretty much completed this gap from April the 3rd. We have pretty much now filled all of that in with today's move. And this would now be getting up above that if tonight's move holds in the morning, as you expect it would, right? We would expect it would there. So we're slowly building to the point where we can finally get the dark green shading and a green line to go with that. We're not quite there on SPX. We are on NDX. The NDX is 3% above the moving average, so we do have the green line forming there. The intermediate line is almost above 80. It's at the 77, so that's how close we were to a cluster, right? Getting a cluster there is both those short-term lines above the 90th percentile and almost above 80 on the intermediate line. Market sentiment rising as well. We're not seeing such bullishness though on the Russell. The Russell is actually down today. Again, flirting as a 30-day moving average. The near-term line coming down out of the reversal zone. The intermediate line is barely in bullish territory. So not looking nearly as strong as those large cap indexes. And of course, your Dow Jones Industrial Average. It kind of looks, again, short-term sentiment looks great. And we're getting a bull tag type pattern. It's just not officially a bear tag, because we don't have light green shading. It's dark green already. And we're almost in bullish territory. So it's been lagging behind 2, and finally it's kind of catching up and getting a 0.25% above the moving average. If you look at the Dow Jones Transportation Average, you can see that it's got very strong short-term sentiment, but it's still well below the moving average. So you can kind of see a little disparity there, and obviously not nearly as bullish. Bitcoin, which is on the far end of the risk appetite scale, you can see it's been really flat and sideways over the past few days. It's not really doing much of anything. It did have an average range yesterday. This is so far with the futures contract today. But you can see its intermediate posture is strongly bullish. Dark green shading in a green line. We're 10% above the moving average. So again, think about this as kind of risk appetite. So risk appetite is relatively strong for Bitcoin there. And if you're looking at other asset classes that we'll look at more here in a second, but the dollar is still showing a bearish pattern. The 10-year yield is still showing a bearish pattern, dark pink shading and a red line. Again, bearish patterns, and both of those were actually bearish for equities in the past, and we'll see if that ends up being the case here going forward. Let's take a look here at the weekly chart for the S&P. And you'll notice, again, a nice, good bullish candle, almost closing up above last week's high point, the high point 55.28. This I can actually close 55.28 as well because we're right there. Again, we still got 2 more days left, so the pretty decent sized body here at, 3.28% essentially. That's what the biggest weekly candle that we've had in a while, right? You have to go back to right here in August of 2024 and right here coming off of the 2023 low point, and then coming off of the lows there during the death cross environment. So after getting a big transition candle last week, turning into more of a reversal with the green arrow, meaning that we are now trading above the 10-week exponential moving average. So very good opportunity here to be pretty bullish for the markets going forward. There we go. My computer's acting up again on me for some odd reason. If we take a look at the 3 green arrow charts, of course, we have 3 green arrows across the board, even on now the Dow Jones, because it's finally gotten above the moving average. So we have our first day of 3 green arrows, our third day of 3 green arrows on the Russell, even if that MACD histogram is starting to roll over, and we have now multiple days, 5 days for the S&P and the Dow. So that's the NASDAQ. That's a very, very good sign to have. Again, multiple days like that. Even with the histogram peaking, the histogram's so high that the MACD is not going to turn red for a while. Right now, probably the indicator that will turn red first is the moving average, because we're not very far up above it, and especially for the Dow Jones and even the Russell, both of those are pretty, have pretty strong MACD histograms, but they're very close to their moving averages there. So that's something to keep an eye on the next couple of days, especially considering that we've had, again, 7 days in a row to the upside on the S&P 500, and we haven't had that kind of a streak in a long time to have 7 days in a row. And if you look at the rate of change over the past 7 days that we've been on the streak, so 1, 2, 3, 4, 5, 6, 7, again, it doesn't seem like we've been, that strongly bullish, but it hasn't been too bad, right? Almost an 8% gain. That's the biggest 7-day return of the past year. And if I were to go back out, like say 5 years, it's one of the big. Well, it is the second biggest. The only other 7-day return that was bigger was coming off of the election results, the weekend that we got the election results and the vaccine rollout, right? So that ended up being a weekend that really prompted some bullishness for the market. So we had a 7-day run there of over 8%. So this is only the second time that we've been at 8% or higher in the last 5 years. So it is a pretty strong run, even if it doesn't seem like we're necessarily building on it, right? You know, coming off of the COVID lows, obviously we had a pretty strong run, and there's that low I was telling you about there. Here, you know, coming off of that low point, we were about 7.69%. So you get the idea, like this is 2019. You get the idea that this is a very strong run, very, very strong run. And we were coming off of a 7-day return where we were down 10%. So, you know, it's kind of nice to see a little bit of a rebound. Now, you know, back here in March, we had a 7-day run here where we had, a 5 out of 6 day return to the up. In fact, we had 1, 2, 3, 4, 5, 6, 7, 8, 9 out of 11 days to the upside. And we had a 7-day stretch there where we're going up 7.3%. So it doesn't guarantee that we're reversing, because it didn't reverse that one. And that actually got slightly higher than the post pullback bounce. And so we're not anywhere close yet to the post pullback bounce here. So it doesn't guarantee that we're done with the correction, but it is a nice, good, strong move there. Let's take a look now at the moving averages. You can see, you know, we're still between the 30 and the 50-day average, so that's going to be a limiting factor, as we can already see. Again, the MACD histogram is peaking and rolling over. If you take a look now, let's take a look at some of these other oscillators. We're looking for bullish breakouts, right? Getting above that 50 would be a bullish breakout. We don't have it yet. Getting above 25 on the positive indicator, this blue one, would be a breakout, with the negative falling below 20. And it's actually the opposite. The negative is crossing above 25, and the positive is potentially crossing below 20 there. So it's not the pattern. It's not a breakout pattern on the DMI. The RSI and the CCI are not breaking out either. We're not above 60 on the RSI. We never got above minus 150 on the CCI, and the weekly CCI is still not even above 0 yet. So still no breakout patterns there. Looking at the Ichimoku cloud, you can see we are above the clouds. You know, above these the midpoints, the 9-day and 26-day midpoints. We still don't have even a weak bullish trend developing. That's how bearish we were. Even with as strong of a 7-day rally as we've had, it still hasn't started a bearish trend. It has a Zweig thrust in here. We still haven't started a bullish trend, excuse me. The rate of change is still negative. You know, you can see it can cross here. It's still negative. We're still well below the cloud, not even threatening the cloud there. So again, we're not in the upper quartile of the Bollinger bandwidth that's declining. The bands are back inside. You know, we have some strong momentum, but the bands are inside the Keltner channels, not outside of them. Right? You have to be outside of them. You have to have green dots to be trending in either direction, but you need green dots to be trending. And right now we don't have green dots. We have red dots. We had green dots to the downside, and so this is a pretty strong move to the upside. In fact, you know, a very strong move. The last couple of strong moves had green dots, and as strong as we've had, we don't have green dots here because, you know, again, how wide, you know, when you have a bandwidth as wide as it is, even coming off of the highs at current levels, that's still higher than any other period in the past year. And if you were to go out 5 years, you can see, you know, again, a pretty strong, like even this, like past 5 years is still a relatively high level for the bandwidth at current levels. So when you have a big bandwidth like this, you're going to get big rebounds, and they'll just be noisy rebounds. If you take a look in terms of, like, you know, okay, how much have we, you know, we've talked about the zigzag, and we're getting another green box here, up almost at 8%. If I were to draw the Fibonacci lines on this, to say, okay, well, how much of this have we reversed now to the downside? And you can see we're up above the 50%. We haven't broken above the 62% level to really say that, you know, we've broke, like we're breaking through resistance to the upside. So that's still not there. And then you say, okay, well, what about, because I've shown you this before, coming off of the correction low point that we had here in October. So if I were to draw the Fibonacci lines from the correction low, which would be, you know, right here at this close. So we'll just come down to this low point here, and then, so I'm gonna have to activate that there, and then move it up here. So we'll activate this again and move it all the way up to this high point. So again, we are barely crossing that 23% retracement, filling in the rest of that gap. So we need to really kind of hold this breakout, because when you break the 23%, you're starting a trend or a correction, because it's a correction low to correction high. You're starting a new correction when you break the 23% retracement level. When you get back above it, you're ending the correction, right? And that's kind of what we're doing right now. If we're going to hold, and remember, we're up so far in the after hours. So if we're going to hold this breakout, that's a very, very good sign that we've ended the correction, as long as we stay above, this 55.20 plus or minus a few points area there. All right, let's take a look at today's intraday range. As I mentioned, up to 560 today. That's not a new 4-week high point yet, but it will be tomorrow, because you can see this comes off, 567 comes off. So we will have this line here, the green line, will jump up to 100 tomorrow. And the red line continues to move over here. We're nowhere close to a new 4-week high. So we're going to have we're going to have a new 4-week high tomorrow for the first time in a long time, right? Since that last day. We had a new 4-week high on that last day on February 19th. We've been down ever since. So that's a good sign for the markets that we got there. But the last thing we want to see is what we saw in 2022 during the last correction that we had. What we don't want to see is, like it did here, again, let me zoom in on, oops, I love it when my computer is like skipping on me. If I zoom in here, is when we got, so here was March. We had multiple days of 4-week highs, but here's that May where we got that kind of quasi-Zweig thrust. We're just barely off of it, and we had a one touch. That's what we do not want to see. We don't want to see a period where we're only up a couple of days. We want to see, a breakout, right? A breakout in the sustain, not a one touch, where we only get a few touches or a few touches. We want to see it really get going to the upside there. So that's kind of something to keep an eye on tomorrow, again, because we will be, assuming we hold this gap to the upside tomorrow morning. But also keep in mind too that it's most likely a depending upon how big it ends up being and whether we run away from the open. Could it be a breakaway gap because you're breaking through 4-week highs? It's pretty marginal, but most likely it's going to be a common gap. So there's a good chance we might fill it in the morning, unless it's, depending upon the size of it. And again, like I said, whether we run away from the open. Let's take a look at I showed you the range got better today, finally, for the first time in a while. The range hit almost average, and the volume hit average. So for the first time, we had a large day of range and volume that kind of made these things go sideways. Remember, we want them to come down, but we want to get through resistance with big moves, because that sustains the breakout. So even if we didn't necessarily go up a lot, at least we did it, and most of the range was because we were so bearish, but at least most of that range was a bullish move during the day. So again, that's a positive development too. And then when you look at the VIX, it's still around 25, hasn't broken 20 yet. It's still, it has broken 100%, but it's still above 95%, so it hasn't broken down out of these bearish levels for risk appetite. You got to get, below 95. Bearish is above 95, bullish is below 90, neutral is in between. So we're still at bearish levels, and the VVIX is still above 100. So we can't get it down below 100. So we're on, it seems like the VIX is at a level where it's having a hard time going any lower than these levels, which is, again, setting us up for, the possibility of a jump higher in the VIX. Remember, the VVIX has dropped, a large percentage in a short amount of time from this peak here down. So it's like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days. We dropped. So I looked at it 11 days and we broke that 200 day. When the VVIX drops that much, it usually leads to a jump in the VIX over the next short period. There's only 2 other times in the history that we've dropped that far in 11 days. And both those instances create a 60% bounce. One took 4 days. Obviously, it's been 4 days, and we haven't risen 60% in the VIX. In fact, you can see since that, in the last 4 days. This is where we were when the VVIX dropped as much as it did in 11 days. We were at 26.47, so we're down a couple of points, even if we were actually up above 26 at the highs of the day today for the VIX. And then a little bit of a long upper shadow is not as bullish. You don't really look at shadows in the VIX, but it does show that people are willing to buy volatility right now. With that the volatility bulls are in the area here. But the idea is still, the second time that it took 14 days, but eventually got up to a 60% gain on the VIX. Again, that puts us up to around 43 if we were to get another 60% gain. It doesn't have to close there, just on an intraday basis. It's touching there. That's what happens after the VVIX drops as far and as fast as it did. So we'll see if it ends up following a similar pattern, because it looks like the VIX is sitting, is at levels where it's having a hard time continuing to go lower. It seems like it's basing based off of the multiple charts that we looked at there. All right, now let's break into what's driving the price action today. As I mentioned, some of the asset classes and how they were performing. Let's take a look at them on a relative basis here. Sorry, let's try this again. There we go. So we'll go to just today alone and take a look at that. And you can see the dollar was up today, which is kind of interesting. It's been down so much. The dollar was up today. That put pressure on commodities. Commodities are way down. Again, commodities are the fuel for economic expansion. And obviously we didn't get that. We got a report for contraction, though, and a lot of that was from the trade component of the GDP. But still, gold was down with a strong dollar. Commodities were down even more. And again, U.S. equities, especially, it started the day. Developed markets and emerging markets, especially, were actually doing pretty well. Emerging markets finished today positive. Developed markets got there with U.S. equities at the end of the day before pulling back. Treasuries ended up underperforming, so yields actually went up today. If you take a look at the 10-year yield, again, as we saw, it started the day down, but then rallied throughout the day and finished slightly higher. So that's a good sign for yields. Here, let me get back. Even with, like I said, a bearish market forecast pattern starting on yields. Again, I don't know why my computer always is so slow. My mouse just doesn't move. But you can see here, and it does stuff like that, which drives me crazy. You can see it's still below its 200-day average. The 10-year yield is, and if you look at the dollar index, as we mentioned, had a positive day today, finally closing above the 8-day for the first time in a while. Still below the 17-day, and we've closed above that a couple of times here and failed. But I think your dollar is going to have a little bit of a resurgence here coming off. It's simply just an oversold technical bounce at the very least, with the MACD coming off of its lows, and we're in convergence mode because the MACD is above its moving average. We're not above the 17-day average there, not yet. But as I mentioned, commodities struggling, and that's a sign. On one hand, it's a sign that inflation is moderating. On the other hand, it's also a sign that economic growth expectations are definitely moderating. And with commodities being already below its 200-day moving average, and not just below the 200-day moving average, but well below the 200-week moving average, so commodities are in a bear market. So it's interesting to see such a divergence between commodities in general and stocks. But that's kind of what's going on there with that move. And if you notice, the crude oil by itself, is down below $60 a barrel. So the first time, well, I guess we did at the lows there got to. But remember, equities are not retesting these lows, but crude oil is. If you take a look at their correlation with each other, that's impacting that. So if I take a look at crude oil here relative to the S&P down at the bottom, you can see now there's typically a positive correlation. Not always, as you can see, but typically a positive correlation. Right now, it's a pretty strong negative correlation. If I zoom out past the 2 weeks out to the 3-month correlation here, again, it's typically a very strong positive correlation, but it seems like that correlation may be breaking. It's either going to be breaking and going back to negative, which, over here it was negative. Crude oil was negative during the 2024 run. in equities. We continue to move higher despite weakness in crude as it moved down to $70 a barrel and got below that. We are in a seasonal time frame for crude to be bullish, so it is kind of interesting that we are again retesting the lows that we're not retesting on equities. Equities aren't even close to retesting their lows there. Let's take a look now at some of the breadth indicators. As you know, we've been really watching the breadth pretty closely, and you know, the McClellan oscillator has been relatively strong. It's still relatively strong, above 50, to the point where your summation index is almost back above zero. Again, looking at 2022 as an example, you got close to zero there in March, and you got above positive 500 in August, and you got close to zero there. But here we are at zero, so we are really making a pretty good run from minus 500 up to zero on the summation index. So that's a good sign, right? Because you have to be above zero to be bullish, right? That's the ideal, to be above zero. When you're rising, when your breadth is strengthening, you're above zero this whole time. You can see over here, there's some pullbacks there. You went negative, but when you're bullish, there you're negative in 2022. But when you're above zero, you're pretty bullish. Until you get your pullbacks below zero. So we were very, very close to getting back above zero, and that would be a very positive sign for equities. Let's take a look at the some of the other breadth indicators that are very important and we're very closely monitoring. Give it a second to load up here. And that is the new highs and new lows. Remember, it's got to get above 100, right? It's got to get above 100, and we're actually negative today. And when you look at, hey, where is it? See if I can find the Wall Street Journal. There it is. So just to make sure it's legit, there 107 versus 129. So yeah, we're not positive. That's not. We got to get above positive 100, and we're not there yet on the new highs and new lows, which basically means that we're not getting we're not getting new lows, which is a good sign. But the problem is we're not getting new highs either. A little bit of a jump today, but we're not getting new highs either, and that's the problem. If you look at the number of stocks above the 50-day average, we jumped above 200 today. So very, very good jump to get well above the average now, jumping above 200. Very, very good sign for that. The number of stocks above the 200-day average, not quite above 100, but that's okay because that means that this ratio has dropped below 1, and that's a very good sign. Right? The further it drops below 1, the better for us to really take off and stay bullish. Right? You can see coming off the 2023 lows and how important it was to get well below 1 and drop down there, and then coming off the 2022 lows, we were way below 1 to get started because when you get so many stocks below the 200-day moving average, you're going to get a lot of stocks above the 50 first, and then the 200 will follow. So you're going to start off coming off these lows with a big drop in this. In this case, down to 60, 50%. So because it means, again, you just have a lot of stocks getting above that 50-day average to really kind of confirm the bounce. So this is the lowest level that we've seen. Now over here didn't really matter because we had a lot of stocks above the 200-day still. But now that we're so low on the number of stocks above the 200-day, we need this to really drop and drop hard, which means that we need the number of stocks above the 50-day. Getting out of bearish territory is great. Now we need to get above, as it did in 2023, go from being low levels to all the way above into bullish levels. That's the ideal. That's what makes that ratio go down so much. 2022, same thing, was at low levels, got out of bearish territory, went right above bullish, right? In a matter of a few days, went above bullish. So that's what we need to see. So here we are out of bearish. There's step one. Now we need to build on it and get up there to much higher levels. When you look at the actual breadth thrust, how many are advanced? Well, here, let's just go straight to the advanced. This is the number of advancers. Today you can see it dropped. Oh, excuse me. This is, today. It dropped down back to 44% advancers relative to total issues in the New York Stock Exchange. So, we had been pretty bullish to get this wide thrust. We got the average up. Now, we're pulling back down. So it's kind of a sign that we're losing some momentum here at this peak, potentially this 7-day rally that we've had. That's produced a very large return that it's kind of hard sustain at similar levels, right? It's hard to sustain, and what we really don't want to see is any kind of reversal at all to the downside. Let's take a look at the sector moves, and you can see during these last 7 days, right, that we've been, so that would be, here, let's pull up sectors first. During this last 7-day rally, you can see today your safety trades all were the better performers, and because they held up during the rally, but and you can see even, well, this is a 3-month chart, sorry. Let's take a look at just today. Because they hold up better during the beginning of the day, right? Staples held up a lot better, but by the end of the day, you can see technology went from underperforming along with discretionary up to some pretty good returns. Utilities, you can see what they're doing. Let's go back to 7 days. So 1, 2, 3, 4, 5, 6, 7 that we've been on this run. Very strong return, like I said, 8%. On the S&P, and those are the 3 sectors we want to lead. So that's very, very good. Your safety trade, your safety sectors are up, but they're not up as much. That's good, right? We don't want them. Energy is lagging behind. That's actually okay, right? Because it's a negative correlation with the markets when energy is outperforming the S&P. So this is all very, very good sign. Even if again from the February low point or February level when we started this decline on the February the 20th. You can see why those 3 sectors are up, because they were down the most, and they're still down the most even after the 7-day rally and this wide breadth thrust from the April 10th close and then the 7-day rally we just barely have had. They're still the weakest performers. The S&P is now only down 10% during this move, and those 2 sectors are still down 13% along with energy, which was a big performer until April the 3rd, and then energy's really dropped off like a rock to the to where it was the best performing during the decline, and now it's one of the worst performers. You can see staples, utilities, real estate, and healthcare all outperforming and almost positive. That's why, again, they hold up better during the declines, right? They don't go down as much, and they get back to zero faster because they don't go down as much. And then, obviously, these are the areas you want to be in once we really get going and start getting new highs. Let's go back one quick, take a look here at the relative rotation graph. Again, this is the weekly version of this. Let's look at the daily version. You can see what's going on here. If I zoom in, there's XLK moving over to the right. XLY is moving up. XLC is moving up to the right slightly. So we're starting to get some good utilities and staples, which have been such big performers, moving down to the left. Energy as well. Energy's over here moving down to the left. There's financials. There's healthcare as well. So real estate's still pretty strong, but again, from a weekly perspective, they're still the best performing asset classes. So we need more than just a few days of XLK strength. We need it to really kind of take off here. And you can see the Qs continues to outperform, but when you look at XLK relative to XLE, 2 bellwethers for different areas of the market, today it was a big breakout move. Back up to 2.6. If I zoom out on this, we can get some perspective on just where we're at relative to historical trends. So we'll go out to the 20 years. You see how bullish we are. Where we're back above we're breaking back out above the 200-day average. Something that's very highly correlated generally with the markets, positively correlated. That's a good breakout to see. Very, very good sign to see there. If you take a look at this XOK by itself here, and look at XOK on this chart, you can see well above the 17-day average. The 8's crossed the 17 now. The XOK is up above its 50-day average relative on the ratio charts above its 50-day average. We have both lines above 100. All very, very good sign. Even momentum is starting to taper, looks like. Still, very good sign for technology, because that's kind of what we need to lead, right? If I zoom out to 2022, so you can see what it did during 2022. There was times that we got above, in March we got above the 50-day average briefly before rolling back over. In May we also got above it briefly. In August we got way above it, before pulling back. But you can kind of see the momentum is actually lower now than it was in any of those peaks. So we kind of, that's, we've talked about that. We've seen the money flow not really matching up, and we still don't necessarily see the money flow necessarily. I mean, look at that big drop that we've had in money flow over the past few days. So even though we are, at pretty decent levels here relative to where we've been in the past, so like right about 311, we're getting there. We're making up some ground, even if the oscillator is rolling over. That brings us down to our trade idea of the day. So let's take a look at the market forecast chart, and it's on Western Digital. Western Digital had its earnings out along with Seagate, both kind of hard drive type companies, technology hardware companies. Very good return. We were already looking pretty good, kind of like the markets, and then big breakout, kind of what we're hoping the market will do tomorrow with this Microsoft and the Meta earnings. Intermediate line's rising. It's not quite above 80 yet. The near-term line came out of the reversal zone, but it's stayed up slightly high. Well, actually, it ended up finishing a little bit lower. It was above. When we did the market outlook, it was actually slightly higher. The momentum line turning back up. Remember when you got from the first day it crosses above 40. So this on day one it crossed above 40 and it crossed above 60. And the near-term lines, the momentum line's above the near-term line. So so this is a pretty good jump in the momentum line. Now we kind of want to follow through on that up to the upside. If you look at the weekly chart for Western Digital, you can see that it's a very good bullish candle we got above the 10-week last week. Very strong body here, and we'll have another strong body next week too. When you look at the 3 green arrow chart, obviously we have 3 green arrows. We're the 8 and 17 day are crossing above the 30 now. MACD is strongly bullish. Stochastic strongly bullish as well. Now, when we take a look at all these other oscillators, we're going to be finding things that we want to see on the markets. So when you look at the DMI, there's what it looks like for the S&P. Well, this is what it looks like for WDC. Above 30 on the positive, below 20 on the negative. That's exactly what we want to see on the S&P. So very good sign there. The RSI and the CCI, you're above 60 on the RSI, and you've already been above 150, but you did again today on the CCI. Again, that's exactly what we want to see on the broader market as a whole. And again, we may get that tomorrow if we can hold the breakout overnight. From an Ichimoku cloud perspective, we have a weak bullish trend, right? It still needs to get to strong, intermediate strength, and then maybe even strongly bullish, but hey, you got to start somewhere, and you got to start weak. You got to at least start with weak, and we're not there on the S&P. The rate of change is almost positive. In fact, a couple more days, it most likely will be positive. We're still below the cloud, but we're moving pretty sharply there, up well above the blue line. Then you look at the Bollinger Bands and the Keltner channels, and we are in the upper quartile of the bandwidth, and we're pushing up against the upper Keltner channel. And the bands themselves are outside the Keltner channel. So these are all things that we want to see on the S&P that we're not quite seeing yet, but we are seeing on Western Digital. So what I decided to do here was to do a long call trade at the mid-30 delta, sell the mid-30 delta, buy 1 strike away. So that gives me a maximum gain of about 1.5 to 1 reward to risk ratio there, with a lot of flexibility, because we're so bullish now. It's probably going to pull back at some point in time, at least in the short term, to short-term averages. So we don't want the max gain to get out of the range just because we're having a near-term decline. A lot of flexibility there, and like I said, about a 1.5 to 1 reward the risk ratio. And there's our trade for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread. With any questions or comments you have, reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody. We'll see you all tomorrow.